What's up, investors? Welcome back to another episode of AQ Markets. As you're probably really well aware, there's some weird debauchery going on in the markets these days, primarily with GameStop and a few other stocks. I'm going to talk about what's going on behind the scenes, how we got to where we are, the background of it, and I'm probably also going to discuss a little bit of the moral and ethical dilemmas that can come with a situation like this. I'm just going to go ahead and say everything, and I'm going to want you to make an opinion at the end of the video. Comment down below and let me know your thoughts. So we saw a few stocks, primarily GameStop, which is going to be the focus of this video, skyrocket hundreds of percents over the last week. And it kind of doesn't make sense because GameStop's not really that great of a company. They are making money, they are making sales, but like, are they really a $300 stock? So let's first start off with some first key definitions and differences that we should understand going into this video. The first thing I want to talk about is what is an institutional investor versus a retail investor. An institutional investor is primarily going to be a big group, big firm, a bank, a hedge fund, or some sort of financial institution that is doing the investing. While on the other side, we have retail investors, which are people like me and you who are just trading from our phones, trading individually, and we're not really tied to any organization. It's just us. Next up is shorting. So in the stock market, when we believe that a stock price is going to go up, we invest in it. We purchase a share, aka we take a long position, and our expectation is that the stock price is going to go up and we're going to benefit from that. Shorting is the opposite. Say if we believe that a stock is going to go down, there has to be some way to capitalize on that, and the way to do it is through shorting. Now the way it works is we're gonna have three parties here. We're gonna have person A, person B, person C. Person A believes that some sort of stock is going to go down in value. What they're going to do is they're going to borrow the share from person B, and then they're going to in turn sell it to person C. Now, the expectation is that person A is going to see the stock go down, and then later, when they want to close their short position, they're going to buy back the share at a lower value, and they're going to return it to B, and everyone's happy. So, if the stock was $4 to start, and when the close of the short position the stock ends up at $2, that person wins. They're going to get $2 because they sold it at 4, bought it back at 2, and returned it. Now, on the flip side, if the stock goes up to $6, then that person's going to lose because now they have to buy it back at 6 and then return it back for the $4 price that they ended up selling it for. They lose $2. Now, when you look at shorting, it is extremely risky because if you think about your possible gains and possible losses, your possible gains are only the value of the stock, aka 100% of the money you make, and that's assuming that the company just completely folds under. On the flip side, your expected loss is theoretically infinite because the stock can just keep going up. For example, it can go up to $300. Now, there has to be some way to monitor how many shares are shorted in the market, right? Correct. There is something called short float. The short float of a stock is the amount of shares that are shorted compared to how many shares are outstanding. If you got 100 shares and 10 of them are shorted, your short float is 10%. Now, typically, this gives a lot of market sentiment around the stock and will let people know what the overall market believes. Typically, 40% or higher is considered heavily shorted, and that's kind of like a bad sign. Maybe there's something that's going bad with the company. It's not going to do well. It's going to have a bad season, or it's just going to fold. But that 40% above number is something that you should definitely look at and be like, maybe I don't want to invest in these guys. Now, every single company does have a short float. Even Apple. Apple's short float hovers around 15 to 20% at some times. So it's not like shorting is extremely uncommon for most stocks that exist. Now, the real definition that we need to fully understand here is a short squeeze. What a short squeeze is that when you have a stock that is heavily shorted and some sort of positive news comes out that would give it some sort of demand that would cause the price to go up, it creates this endless perpetual cycle because the people who are on the short side of the stock are going to want to close their position to cap off their losses. The problem is that the people who are selling the shares might be like, you really want those shares, don't you? And then they're just going to start charging ludicrous prices, and these people, in order to cap off their losses, will be willing to pay it as the ladder climbs up. That is what's called a short squeeze. From an economics point of view, basically the demand skyrockets and the supply stays the same, so the prices keep going up. And this is how certain companies like GameStop, Nokia, BlackBerry, and AMC saw some insane, ludicrous prices that does not fundamentally make sense when you look at their business model. All right, now that you have all the pieces of the puzzle here, let's get down to the story. And this is a real battle between institutions and retail investors, a real David and Goliath tale. It all started by one guy and was fueled by one subreddit on the popular social media site Reddit. Michael Burry, who you may know as Christian Bale's character in The Big Short, he's actually a real guy. Michael Burry. He was a doctor, turned into the hedge fund business, and then he became a legend because he was the first person to pick up on the subprime mortgage crash of 2008 before anyone else did. He was in fact talking about how these bonds are going to crash in 2005. And he lost a lot of money for those first 3 years. And then when it finally crashed, he became a hero and no investor ever doubted him again. But then he ended up retiring and now he just runs his own little fund with his own money. So he actually did an analysis on GameStop and he entered a really large position at the end of 2019, citing that the stock had a really high intrinsic value. The market is over shorting it, and he believes that they have a lot of potential going forward. At the time, GameStop was valued at around $250 million. So he really saw that this company was undervalued at that price. Now, fast forward a few months later, we hit the pandemic, which absolutely decimated the stock market. And hedge funds were really going heavy onto some shorts because they were looking at companies that were not going to make it out of this pandemic. GameStop was one of them, and they really thought that they were going to go bankrupt. And they further shorted and shorted and shorted this stock, GME. Now, side note, let's talk about bankruptcy and public companies real quick. When companies file bankruptcy, there's two main types that are filed in public companies. There's Chapter 7, which means that the company is going to cease to exist, halt business operations, and just straight up default and just die in a corner somewhere. Now, there's Chapter 11, which is different. This is when they're going to restructure the whole company, the whole debt and the equity, which is the stocks, in order to kind of just push a hard reset on the button and put it back in a place where the company can be profitable again and continue its business operations. The thing is, though, is that in both of these scenarios, the shares that were originally owned by whomever, they become obsolete after the filing. So if you were to have shorted the shares prior to a bankruptcy, you're free to go because those shares don't really exist anymore and there's nothing for you to return. This is exactly what institutions were betting on. They bet on it so hard that the short float of GameStop was 140%. That's right. They overshorted 40% of the shares that existed of GameStop. So like any normal person, you're probably here trying to figure out how 1 is equal to 1.4. It's kind of hard to do with fingers. And I'm going to make this really cool spider web thingy on the camera so that you can see. So you should like this video just off of that alone. Let's get into it. Remember how I was explaining the shorting example where we have person A and person B. Person A borrows the share from person B and then sells it to person C. And that person's eventually going to have to buy it back later so that they can return it to B. Well, the thing is that these people don't know each other, okay? Let's make that clear. And most important of all, person C doesn't realize that they just bought shares that were shorted. Now let's introduce two more people into this magical adventure. We have person D and person E. If person D also believes the stock is going to go down, they are going to now short it and they're going to borrow it from who else? They're going to borrow it from C. All right. And then they're going to sell it to this poor guy, person E. Person E, again, they do not know each other. And person E does not realize that they bought a shorted share. So wait a second. That same share, it's just been shorted twice. So now if GameStop starts climbing up all of a sudden, people A and D, they need to buy a share and they need to return it to B and C respectively. But in this example, nobody knows each other. No one knows where that share went because person E has this one share. So if you were to do a short float example on just these 5 people, the short float's 200%. Person E now is going to be really smart and be like, hey, I'm going to need about 350 for this share. And they're going to sell it to the highest possible price that they can get. This is one way that shares get overshorted. There's along with another way that involves stock options, which is a bit more complicated, so I'm not going to get into that right now. So now we got Michael Burry entering this position. We have the shares overshorted at 140%. This is when the supervillain or the superhero, whatever side you want to take, jumps in, and that is the subreddit Wall Street Bets. Wall Street Bets has been quite a heavily discussed concept in the news right now. And if for those of you who do not know what Reddit is a social media platform where you can create basically an open public forum about a certain topic, discuss whatever you want, post memes, you could be serious, you can talk about your own personal experiences. It's really interesting. So within Wall Street Bets, I would honestly say the age group of there is anywhere from 16 to 75. And these are people who trade stocks and options with as little as $100 and as high as millions of dollars. They often take really speculative positions and they post their insane gains or their insane losses and they either celebrate or sob together. When this subreddit learned about Michael Burry's trade, there was one new legend that has come up into the fray, and his name is Deep Effing Value. Not going to say the name because my mom would be very upset with me. He dumped around $60,000 into some open positions on the stock options, and he's worth well over 40 million now. So on this open forum that was publicly visible, free to use, GameStop was a hot topic. Many people discussed that there is a fundamental thesis and a strong reason to hold GameStop. And in investing, it's important to kind of read all of this information, understand whether you're going to agree or disagree with it, and act upon it. Within this subreddit, many people acted upon this information and in this thesis, and they all agreed that buying GameStop is a good idea. A majority of them did, and to top it off, they refused to sell. This is where the problem happens now. The institutions that were shorting the shares, they were getting pummeled because they shorted so much of this insane stock that was increasing and it was causing them to lose billions of dollars. The poetic justice about it is that these were just retail investors for once. It wasn't a hedge fund against another hedge fund. It was just people like you and me sitting in our rooms, working our 9 to 5s, buying 10 shares of GameStop. We were winning against them essentially. The institutions that were on the wrong side of this trade was primarily Melvin Capital, who had investments from another hedge fund called Citadel and another one called Point 72, and there was also another party called Citron Research. As it stands right now, an estimated $19 billion has been lost from institutions betting on GameStop's demise. So now the big controversy that you can see all over the media is the media and a lot of organizations are trying to claim that Reddit was doing market manipulation, which, as it implies, basically manipulating a stock price in order to gain from it personally. And the issue is here is that it's often speculated that a lot of these hedge funds and these big banks and massive institutions, they have dealings behind closed doors that would be considered market manipulation. And they're basically arguing that this is a public forum. Everyone can read it. It is not hiding behind doors, and it's not some private conversations that are being held between massive powerhouses that are moving the stock market. So they're saying this is not market manipulation. This is actually a fundamental, well thought out thesis that holds value when it comes to investing in the stock market. So the media essentially is trying to paint a picture that the retail investors are the ones to blame, even though they're the ones that are making money when big institutions that are in the top 1% are the ones losing money. They're trying to say that the subreddit Wall Street Bex acted immorally and unethically, but no one's asking the question, how did 140% of shares get shorted in GameStop? How did the SEC, clearinghouses, brokerage houses, the overall stock market, how did they allow that to happen? And that is the fundamental case here because they seem to dodge that question all over the media. And things got even worse on Thursday, January 28th, because if you opened up your Robinhood app, for example, you basically saw this on the search bar. The search bar was broken initially. Then, fast forward about like 20, 30 minutes later, if you were to type in GME, the search would just not go through. GME didn't exist as far as you're concerned. Now, what if you were a holder in GME the day before? You had this message on the bottom saying that you are not allowed to buy anymore, you can only sell. But on the other hand, you had institutions, they were allowed to buy GME freely as they want. So now you're telling retail investors that during the same day on the same hours, you cannot buy any more GameStop. But then you're going ahead and telling institutions you can buy GameStop, aka they can sell and you can buy it from them, and the prices are going to come a lot more lower because these people are freaking out thinking something's going to happen. And that allowed a lot of short positions to be closed at a much lower price, which would lower their overall loss at the end of the day. Something's a little fishy there because the true irony in all of this is when you look at Robinhood's founding principle, and it's even on their Twitter bio, we are here to democratize investing and financial freedom. Robinhood became Robin the Hood. So a lot of you who did not invest in these kind of companies recently, you're probably like kicking yourself in the butt right now, but please, it's okay to feel FOMO, but do not act upon FOMO. That is emotional investing. It's not going to end well. I'm not saying that GameStop's going to crash or skyrocket or do anything tomorrow. I have my own opinions on that, which I'm not going to talk about. But at the end of the day, there is a really big learning opportunity from the events that have taken place. And what you should do is learn from them and then incorporate this into your investing strategy and your overall outlook in the market going forward. Let's talk about 3 major things that I'm taking away from this. 1, finding stocks that are susceptible to short squeezes is an extremely valid strategy, and studying what leads to this could pose some really good investment opportunities for you guys. Number two, information is valuable. Do not ever discredit where this information comes from. In investing, it's important to take all opinions and all research and incorporate it into an investment thesis because it can assist you. So do not discount the media. Don't discount Reddit. Don't discount the guy you talk to in line at the supermarket. Everyone has an opinion, and sometimes you can nitpick things that are true and incorrect and end up becoming an extremely good investor off of these kind of principles. Read everything. Don't discredit everything. Just read everything you can. Three, trading is extremely risky, and it's extremely important to understand your own risk tolerances and be disciplined. So this goes back to me saying, do not fall for FOMO. Believe in yourself, believe in your strategy, and stay true to it because that ultimately will benefit you in the long run. Don't look at these short-term things. Don't look at the fact that people are becoming millionaires because there's also people who are losing millions on the same side. They're just not as vocal about it. Obviously, people are going to be more proud than they are embarrassed. So you're going to see more things online about people being really proud than talking about how they might have lost $40,000. So relax. Too long didn't read. Institutions were wrong. Retail was right. Institutions are losing a lot of money and they want retail to face the repercussions. Now, I hope this video was super informative and I hope it cleared up a lot of the air. But more than that, I hope it really made you feel okay about what's going on and made you feel okay that you did not invest in GameStop. Super risky stuff. It's okay. Stay out of it. Anyway, with all that information, why don't you comment below your opinion on this whole matter? Do you think anything was unethical? Do you think anything was immoral? Are you on team retail? Are you on team financial institutions? Drop a comment below. Most important of all, please give this video a thumbs up and subscribe to the channel if you haven't already. I'll see you guys next time. Thank you.